Good afternoon. Good afternoon, everyone. On behalf of Western India Regional Council, it is my great pleasure to welcome you all on today's program on taxation of charitable trust and NGO with recent amendments, which is always a subject of discussion with so many changes. So before starting the session, I request everyone to put your hand on your heart for the ICI motto.
येष सुप्तेषु जागृति येष सुप्तेषु जागृति कामं 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 कामपुरुषो पुरुषो निर्विमाणः निर्विमाणः तदेव शुक्रं तद्ब्रह्मा तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यति कश्चन एतद्द्वैता 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 एतद्द्वैता.
Thank you, everyone. So we have with us today our visionary chairman, CA Murtaza Kachwala, sir. I recognize the presence our chief guest, Principal CIT Exemptions, Anurag Sahay, sir. Speaker of today, CA Ravi Gupta ji. Regional Council member and treasurer, CA Piyush Chandak. Our own member and past WRC member, CA Shardul Shah, sir, and all my participants. So moving further, now I request to our chairman WRC for his welcome address and sharing his vision and thoughts with our participants.
Thank you, Shweta madam. A very warm good afternoon to all the participants. Let me first welcome Shri Anurag Sahay, Principal CIT Exemption. Sir, welcome. And sir, thank you very much for accepting our invitation. We are extremely grateful, sir. I also welcome CA Ravi Gupta, faculty for today. Ravi ji, extremely grateful. Thank you for accepting our invitation and deciding to spare your valuable time with all the participants today.
Thank you, sir. Thank you so much.
Let me also recognize and thank Shri Shardul Shah, past council member. Shardul bhai, extremely grateful for all the support that you give to WRC throughout. Means anything from a chief guest to organizing a program to a topic and anything, and we pick up. So he is a like man Friday to whom we reach out to and say, Shardul bhai, we need support. Thank you. Thank you for being there. Let me also thank the convener or the chairman of the Direct Tax Committee, Hitesh bhai in absentia, and the vice chairman of the Direct Tax Committee, Piyush, who is also a treasurer at WRC, for organizing such a nice program today. Piyush, thank you. I also recognize presence of Secretary WRC Shweta Jain and my regional council colleague Gautam, who is with me here in the room. Sir, when we talk about charitable organizations or trust, actually the name is a little misnomer, because even if we look at the city like Mumbai, the large hospital, maybe a Jaslok or whatever, that is run by a charitable organization, and the turnover is into crores, like I would say hundreds of crores or thousands of crores. And there are charitable organizations where they've got multiple hospitals and multiple educational organizations and multiple whatever in under them in one banner under the one name. And at times maybe the expectation of stakeholders from chartered accountant is that we like all knowing and we should do everything to uncover everything that is happening there. But at times I think my personal feeling that is that the regulations, although the turnover of some of these trusts maybe running into crores of rupees, thousands of crores, and it should be equivalent to a large corporate or even much more than a normal corporate. But then I think the controls in terms of governance are like much lesser. That is what I feel. And like for a company, now you introduce internal control over financial reporting. So something like that is missing in case of the large trust. Maybe beyond a particular turnover threshold, if something like that is there, that will be nice. And in many of these trusts, when we go to do the audits, there are like the basic procedures or policy documents are also not there in place. At times, authority metrics is missing, and maybe they're not even using those very sophisticated softwares, accounting or operational softwares at times. Some, of course, are moving up the chain with the huge volumes and turnover, but some are still onto very, very basic stuff. And at times, like enough and more documentation and the things are not available for a chartered accountant as well. So maybe there is a need in terms of regulation, because that will also help us. The organizations, if they become stronger in their control environment, then it will make the of course, one vested advantage is we'll as chartered accountant get a lot more opportunities, because we only will then go and write the policy, procedure, design the authority metrics, implement the software, etc. But overall, the control environment will improve. So I think that is one. And at times, sir, like we do a test check on the basis of the samples that we select. And the samples when we select, we technically get 3 quotations comparative statement. But beyond the point, maybe we are like not a bloodhound, we are not investigators. And at times, maybe it happens that like they have all the documentation in place, still maybe something is going wrong. So how do the regulator address that, or how can we as chartered accountant be strengthened a little more? That is one thing maybe which I would request you, Anurag sir, maybe you can throw a little light on that as well. But when I talk to my colleagues here who join, almost 250 chartered accountants have registered, and we can see almost 180 already inside in the program. Of course, with the whole CSR and the organization, large corporates looking to spend the CSR spending, and they approach various of these NGO charitable organizations, and through them they do, and people and organizations are setting up also large charitable organization or CSR organization to fund and do various activities. So I think there is lots and lots of activity which is happening, and a lot of opportunities for us as well. And the overall CSR area, I think I'm seeing people who are spending time and energy in doing consulting, and they're doing really well. So I think a lot of opportunity, and I'm sure we're going to learn a lot of stuff from Anurag ji and also from Ravi ji today. So with that, happy learning to everyone. Thank you very much for joining the program today and making it a success. And over to you, Shweta madam. Thank you.
Thank you. Thank you so much, sir. For, of course, yes, there are a lot of new opportunities are there. So, friends, we are very glad to inform you that today on this program, and with the gracious presence of Anurag Sahay ji, we are unveiling our publication on charitable trust and NGO. So I request to the team, please, can we have a cover page of book? So thank you. So now this new publication of WRC is out, and this is very useful book, friends. And if you want to order it online, you can order it online also. Details will be very soon available on our WRC website. So now time to hear from our chief guest, but before handing over charge to him, I would like to request Piyush Chandak ji to please introduce our chief guest.
Piyush, before you start the introduction, Anurag sir will personally come along with Shardul Bhai and present this book to you, sir.
Yes, sir.
It's a lovely edition, and we'll request for your feedback as well. And Ravi ji will also courier you the publication. Thank you. Over to you, Piyush bhai.
Okay, sir. Thank you. Thank you very much. Welcome, Anurag sir. About Anurag sir, what to say? Honorable Anurag ji is IRS from 1991 batch, and presently working as the Principal Commissioner of Income Tax Exemptions, Mumbai. He has worked within the department in various capacities at Kolkata, Bangalore, and Chennai. He was on deputation to Ministry of Defense as well, and has worked as the Chief Vigilance Officer of the Hindustan Aeronautics Limited. He was awarded National Vigilance Excellence Award in 2013 and Vigilance Innovation Award in 2014. He is an alumni of Jawaharlal Nehru University, New Delhi, and National Law School of India, University, Bangalore. He was awarded as the prestigious Fulbright Fellowship for 2014 and 15 and pursued public policy at the University of Washington, USA. With this brief introduction, I'll request Anurag sir to please take over the charge. Thank you very much, sir.
Thank you so much, Piyush, for the warm words. Mr. Murtaja, Mr. Shardul, Mr. Ravi, all the friends and colleagues who have joined this seminar today. You see, this seminar could not have come at a better time in terms of the flurry of changes which we have seen in the field of charitable trusts. Because the focus of this government, if you see from the last 3 years, have been to completely reform and streamline the process of the way we administer the taxation of charitable entities. And we are a very small vertical in the department. For those who may not know, I must share with you, we are just 14 commissionerates covering the entire country. And in a country where we have more than 7 crores tax ITR filings in a year, we are just 2.25 lakh returns filed for charitable entities. We are so small, but why we pack a punch is because of the fact that amount applied towards charitable activity in a year exceeds 7 lakh crores. So it means that almost 50% of the total direct tax collections is being applied towards charitable activities in India by various institutions. So there is a need to regulate and, streamline the existing provisions. So this whole process, this started with Finance Act 2020, with the coming in of the new scheme of registration. And indeed, in the last 3 Finance Acts, you would have seen 20, 21, and 22, almost 90% of the streamlining and tax reforms have been completed. And the basic philosophy behind these changes which have happened was very succinctly, put, if you can see the explanatory memorandum to Finance Act 2020. It basically lays out why the roadmap for the change and why these changes were made. And the roadmap was that we need advent of technology in the process of tax administration. What was happened was that we had 12A from 70s till 1997. Then we had 12AA, which went on till 2020.
Yeah.
And it was continuously, both these were simultaneously continuing. Earlier, there were jurisdictional CITs who had issued registration certificates. Then there were CIT exemptions. Then there was partly issued by the system. So there were different nomenclatures. A lot of charitable entities had gone extinct. They were no longer filing returns. There was no way of, completely streamlining them into a uniform system unless we did this radical change through infusion of technology. A need was also felt that we should be, reducing the time lag which we are taking in the issue of certificate of registration or approval under Section 80G of the Act. So that was also a thing which was in mind of the policymakers. The other important thing was that one message was that we need to trust the taxpayer.
Yes.
And we need to respect the documents that it granted provisional registration to an applicant entity without any verification based on your documents alone. And it was also held in that explanatory memorandum that there will be no roving inquiry by the department, day-to-day inquiry by the department. Your registration will not be revisited every second day. There'll be a fixed timeline of 5 years, and your registration will be subject to renewal after 5 years, at which point in time the commissioner will have the necessary authority to look into your activities, to verify your objects and see your genuineness, and then either continue the registration or to, not, or to reject the application. But the most important thing is that there was this complete streamlining, and despite the fact that those were the pandemic years where we introduced the new scheme, now the new scheme has settled down, and now we can see that provisional registrations are getting generated in less than 4 weeks, and they are landing into the desktop and email IDs of the applicant without any running around to the offices of Income Tax Department. You have your registration, you can commence your activities. So if you see the kind of changes which has been made in the last 3 years, I would broadly categorize it into 3 kinds of changes. Of course, I'll not go into details because I know Mr. Ravi will deep dive into each of these changes which have happened and explain the various finer nuances to all of you. But just broadly speaking, you see, there are 3 changes which have happened if you closely look at it. Number 1 was I already spoken about it, overhaul of the scheme of registration. Number 2 is the bringing parity between 2 schemes of exemptions. That is the first regime under 1023C and the second regime under section 11. So this was also our constant demand to the CBDT and tax plan division, because there was a lot of arbitrage opportunities between these 2.
Yes.
So in Finance Act 2022, and I'm sure Ravi would spend a lot of time dealing with it in his presentation, there a very conscious attempt has been made to streamline the provisions, to bring parity to the provisions, so that there is an ease of implementation and understanding, both at the level of the tax professionals and also at the level of the tax administrators. Of course, we were wanting that there should be only one scheme. That was what we were pitching for, that let there be 1023C scheme, but let everything of section 11, 12 and 13 apply pari passu. Why you have 22 provisos and so many subsections? But maybe that is something which may be looked by the policy makers in years to come. But as of now, there is almost 95% parity between these 2 regimes. So that has happened. And the third thing which has happened is simplification and rationalization of existing provisions. And where there were some court decisions which the legislature was not in agreeing, just as in case Subro's case, in the case of deficit, and several other decisions, Father Mueller's decision on 13(1)(c), whether it will be full or partial. So, and how to compute the income when there is a denial of exemption, which was leading to a whole lot of litigation. So all these stuff has been streamlined in the Finance Act 2022, so that when we go forward implementing these changes, there is less scope of litigation, more scope for surety, and better tax administration all around. But while I'll tell you, without going into the specifics of the changes made, let me tell you what the CBDT has been doing all this time, ever since the changes have been made. Because the changes are so fast and furious that it has become difficult for even you professionals and we tax administrators to be up to speed with them. And we are not talking about the charitable entities, whose core competence is something else and who are solely dependent on both of us to, give them the better mind space so that they could do the altruistic activity they are, targeting for. So what CBDT did during these 3 years, I would like you to appreciate that how proactive the ministry and the tax administration has been. See, number one was the condonation of delay under 119(2)(b). Various circulars were brought in, circular number 2, number 3, number 6 of 2020, condonation later for 10(b)(b). And then now condonation has been made 2018-19 onwards, and powers up to 365 days has been granted to the commissioners of income tax. And beyond 365 days, they are not getting rejected. The taxpayers have the options directly to apply to the CBDT, or through the jurisdictional commissioner of income tax, it can be sent to the CBDT for consideration. And on a case-to-case basis, CBDT is taking a call on delays beyond 365 days. And we have been administering the condonation powers with a lot of hand-holding, care and concern, because we know that the unprecedented times which all of us have gone through. So this is a time not to be very, very rigid and very, very technical about the defaults. As long as the figures are, in sync with ITR 7, we are taking a pro-assessee stand. And I'm glad to tell you, in Mumbai alone, we would have, reduced demand of at least 1,500 crores, which was raised due to, default in filing Form 10B or Form 10, etc. So this is the one condonation powers which is continuously coming. Then we had delay in implementation of the new scheme of registration. It was supposed to be implemented by Finance Act 2020. Pandemic, we delayed it by one more year. Then we had, recently you would have seen that circular number 8 was, introduced by CBDT, where time given for application of Form 10AB was extended up to 30th of September. All these are really proactive, taxpayer-friendly measures, so that, because of pandemic, some people may have commenced the activities but were not able to apply. And in some cases, because our own portal was not ready, there was a lot of technical problems happening. So additional time was given, and they can still apply up to 30th of September, Form 10AB. And as some of you may be knowing, Form 10AB is not an automated processing of Form 10AB. While Form 10A, assessees file on the portal and CPC grants an automated registration. Form 10AB is also filed on the portal, but then Form 10AB is pushed to us. We get your applications with all the enclosures, and we will have to then process it ourselves by issuing you a necessary notice, by satisfying ourselves with your objects, because when we have granted you provisional registration or approval, your objects have not been verified. So we would like to see whether it conforms to the definition of charitable purpose under Section 215. And we would like to see whether your activities are in sync with the objects. We would also like to see whether there is a violation of any other law that is material to the conditions in which registration is granted. So all these things will have to be verified. So for that, we would be issuing necessary notices. To the extent possible, we would deal with it in a email mode. Send you the questionnaire or requirements, receive the requirements. If we are satisfied with that, we will extend the registration under 10AB for 5 years, or if we need further clarifications, then maybe we will call you on a case-to-case basis. There may be verifications or some third-party verifications in some cases, but that is the way going forward. And I'm glad to report to you that we have already received around 1,000 Form 10AB cases in Mumbai alone. So our work is pretty much cut out for the year, and we are to issue a lot of 10AB registrations by September this year. Further, you would also have noticed that we have issued clarification on Form 10AC. Circular number 11 was issued, where there was a lot of problems in the terms and conditions of grant of registration. There were technical glitches, where a lot of some of the terms and conditions were not exactly as per the scheme of the Act were put in, and because terms and condition of registration is a specified violation, if you don't follow. So a lot of anxiety was created amongst the taxpayer community. A lot of cases were also filed in Mumbai ITAT against the grant of that terms and condition in Form 10AC. So this Circular 11 has clarified all that, and it has said that where inadvertently, instead of regular registration, the word provisional was used for the pre-existing cases, that will be deemed as regular registration. So all these proactive measures have been taken by CBDT, so that we can assist and handhold the charitable entities in discharging their compliance burden. And coming to the compliance burden, this is something I would like to flag all of you, dear professionals, that the demand on charitable entity for regulatory compliance has substantially increased in the last 3 years. You will see a renewed Form 10B and Form 10BB coming in very soon. And this Form 10B will not be a small 3-line, 4-line, half-page form which you can fill in 5 minutes. You will have to apply your time and energy and properly fill, because the intention again is to capture data, to create non-adversarial regime, so that based on the data, we are able to do our risk analysis and throw up cases for scrutiny. For cases which are compliant and which are meeting the benchmark, they will not be selected for scrutiny or deeper verification at all. So a more robust Form 10B is going to come. Similarly, accumulation report like Form 10 is going to be issued for the 1023C regime. You would have seen now the consequences of non-compliance, either to filing of ITR or non-filing or belated filing of accumulation report, is severe, because it may result in either in complete denial of exemption or it may result in denial of accumulation. So therefore, there is a lot of onus cast on the professional community to assist the taxpayers so that they are able to file their statutory reports in time, they're able to file their ITRs in time, they're able to file their Form 10BDs in time. Now, Form 10BD is something new which is coming. And I know there were several issues relating to non-availability of PAN, etc. That has also been now, slightly, that has been, the change has been made, and people are now able to input the name and address and without PAN, and this is going through. The concept of pre-authorized, what is it called, PRAs, pre-authorized receipts has been introduced, which will shortly be implemented. So Form 10BD needs to be filed in time. 10BE needs to be issued, so that if the 10BD is not filed, then there is a problem, because then a genuine donor will not be able to get his ATP deductions. So this onus is on the charitable entity who actually is the beneficiary of that largesse, of that the charity by the donor. So that responsibility is cast on the charitable entity, and through them to all of you, to help them ensure that there is proper compliance. So there's a whole exciting landscape in front of all of us in terms of for you to help the taxpayers implement the new provisions, and for us to administer the new provisions in as painless and as seamless manner as possible. So that is a challenge before both of us. I hope all the stakeholders rise to the occasion and help the noble concept of charity in the country. I will not take further time. It's a pleasure to come and address all of you, and I hope the seminar great success and very, very educative and learning experience to all of you. Thank you.
Thank you so much, sir.
Thank you, sir. It was so nice of you to share ground realities and insights about the charitable trust and the regulations, and showing an understanding that we CAs also may face various difficulties while complying with the formalities and legalities. Sir, आप इस टेक्निकल ग्लिचेस के अंधेरे में हमें एक ऐसा चिराग नजर आ रहे हो जो कि हमारे सही कंप्लायंस के रास्ते पे चलने के लिए हमारा हाथ थाम के हमें मदद करे. So with this, I recognize the presence of CA Aditya Surte, a contributor to the today's publication, and I'll further request CA Shardul Bhai Shah to present a formal vote of thanks to Shri Anurag Sahay ji, and also to introduce today's speaker on the topic. Thank you, sir.
Thank you, Piyush Bhai. Respected Chairman of WIRC of ICI and my very dear friend Murtuza Bhai. Respected Shweta ma'am, respected all the other office bearers of WIRC, Piyush Bhai, respected our faculty, Mr. Ravi Gupta ji, and other coordinators of WIRC on this program, and also all the contributors who have contributed to this esteemed publication. Friends, this is a very, very important day for us, where we have had one of the finest, gentlemen or finest person from the Income Tax Department, Mr. Anurag Sahay, with us, Principal Commissioner of Income Tax Exemptions Mumbai. He's recently been promoted also, and it is indeed our great opportunity to hear words of wisdom from him, because he's one person I have seen that he's absolutely neutral, because a lot of times when you meet income tax authorities and bureaucrats, they have a kind of a one-sided approach to looking at things. But sir is one of the finest professionals or finest tax officer which we find that the government have had, that he has given such kind of direction to us, and the knowledge is wonderful. Sir, you have shared so much of knowledge. We have really been enriched, and I'm sure all the participants would have also appreciated the same. On behalf of WIRC and all the participants present here, I propose a well-deserved vote of thanks to you, sir, and I thank you for sparing your valuable time for us. Thank you so much, sir.
Thank you so much. With your permission, I will exit from the group. Thank you.
Thank you so much, sir. Thank you. Friends, indeed, it's my pleasure today to also introduce a very fine faculty and a human being which I know is par excellence, Shri Ravi Gupta ji. He's been a chartered accountant, a founder of Ravi Gupta and Associates, and has more than 2.5 decades of experience in the field of our professional. He's also he's also a professional. He's basically into formation and taxation, charitable trust, in audit assurance, direct indirect taxes, financial planning, tax planning, scrutiny assessments, project appraisals and reports, loan syndication, formation of companies, RERA, and he has cleared also the limited insolvency examination in 2017, and has supported the services in the insolvency resolution cases. He was also the member of Cooperative Societies Committee of WIRC for the year 2021, and is currently an active member of the Insolvency and Bankruptcy Code Committee of WIRC for 22-23. He speaks regularly on the formation of and taxation of charitable trust, and he has regularly contributed to the ICAI. He has addressed various forums and senior officers of CAG on audit and taxation of charitable trust. He has addressed officers of leading educational institutions and medical institutions with charitable trust, along with the recent amendments in the law also with this happening. So with these few words, friends, I would like all of you to kindly welcome our esteemed faculty, Shri Ravi Gupta, with a round of applause. And we are indeed fortunate, Ravi ji, for having you come here on the dais and spare your valuable time. I request you to share your words of wisdom with all the members present here. Over to you, Ravi sir. Thank you.
Thank you so much. First of all, let me thank the entire WIRC panel, basically respected chairman, Mr. Shardul, and then respected secretary Shweta Jain, and respected treasurer Mr. Piyush Chandak, CA Piyush Chandak, and very close friend Shardul Shah, and all the other people who are participating in this program. And I'm very much enlightened with the knowledge which Mr. Sahay has shared. Of course, he is not, he's absent now, he has logged out. But of course, he has done half of the job, basically, as far as I'm concerned. Of course, I'm left with very little time now. Of course, 2 hours is also a limited time for this subject, but I will try to do justice with whatever time I have at hand. And once again, thank you to all the office bearers for giving me this opportunity. So I will share my PPT and start the process right away. My screen is visible. PPT is visible.
Yes,
Yes,
sir.
sir. Yes,
Yeah.
yes.
Yes, sir. Yes, sir.
Yes. So let us begin with the subject: taxation of charitable trusts and NGOs with recent amendments. This is my table of content today. Of course, I think I'll have to skip something because I have been left with very little time. And one more thing which I want to know is how much time should we keep for the question answer session? Some 10-15 minutes will be okay, I believe.
Yes, yes, perfectly fine.
Okay. I'll continue with the subject then. This is the table of content. This is the syllabus basically which I am covering today. Section 215, 1023C, 11, 12, 12A, 12AA, of course, replaced by 12AB. Then I'll be talking about section 13. A lot of new sections being introduced. I will cover those sections. Then talking about a very recent amendment by the Finance Act 2022, Finance Bill 2022 in section 143(3). Then finally 164(2)(3) vis-a-vis 167B. So this is my syllabus today. Of course, let us start right away. Coming to section 215, a very important section. I would recommend all the participants to thoroughly go through this section. It is a definition section basically, and it is a very inclusive definition. First of all, charitable, it defines the charitable purpose. Now, what is a charitable purpose and what does it include? First thing is it includes relief of poor. Second, education. Third, yoga, introduced by the Finance Bill 2015. Then we talk about medical relief, preservation of environment, preservation of monuments, and then finally the residual section. Now, after going through section 215 and many case laws related to this section, I have jotted down certain pointers which will be of very great help to the participants. Now, what are those pointers? First thing, a lot of queries can be sorted out by going through these pointers. So what are these pointers? First and foremost, the definition of charitable, as I said, is inclusive. Charitable purpose is inclusive as defined by section 215. All the limbs of section 215 are not mutually exclusive, they may overlap. For example, what does this mean? Suppose if you are sponsoring an education of a student, in that case, you are supporting education as well as you are supporting relief of poor. So that is what I mean by saying that the objects may overlap, the purpose may overlap, and the objects are not mutually exclusive. Then one more pointer, a purpose must, in order to be charitable, be directed to the benefit of the community or a section of the community, as distinguished from an individual or a group. That everybody will agree that this is a public charitable trust and the beneficiaries are a fluctuating body as far as a public charitable trust is concerned. Then we talk about, well, then one more thing is not necessary to benefit the whole of mankind. Suppose if you are coming up with a trust and you are helping a large section of the society, in that case also it will be considered as a charitable purpose. It is not necessary to help the whole of the mankind, because charitable trusts are formed for various purposes, for various reasons, and different pockets of the society and different types of people. So it may not benefit the whole of mankind. If a substantial community is helped, for example, if the society is formed for, say, Jain community, even if they are helping the Jain community, of course, it is very difficult for the benefits to be targeted to a particular community. But then too, if it is so, it is fine. It will fall under the charitable purpose, subject to certain conditions. Then, not necessary to provide free services. There are many queries nowadays. Suppose if you are running an educational institute, in that case, should we provide the education free of cost? No, it is not required, because if you provide the education free of cost, how will the institution run? Suppose if you are running an hospital, in that case also, if you are providing free services, how will you run the hospital without money? So it is not necessary to provide free services. Then presence of a fluctuating body of beneficiaries, that I have already covered. Then coming to proviso. Proviso to section 215 introduced in the Finance Act 2008. What does this proviso say? That if you are doing some commercial activity, your commercial activity, so that your charitable organization is considered as a charitable organization, your commercial activity should not exceed 20% of the gross receipts of the organization. And this is from the financial year, from the assessment year 2016-17. Earlier the limits were different, but now at present 20% is the limit of the gross receipts. If your gross receipts, if the revenue generated from the business activity is more than 20% of the gross receipt, in that case, your organization will not be treated as a charitable organization for income tax purposes. Now, the intention behind this is, the intention is to limit the benefit to entities which are engaged in charitable activities and to deny it to purely commercial and business entities. Earlier, such organizations were allowed, but nowadays, such organizations are not allowed. Certain case laws, I'm not reading the case laws, certain case laws supporting the provisos and supporting the section 215, of course. And one more very important thing, the above restriction of 20% of the gross receipt does not apply to the first 6 limbs of the charitable purpose. The 20% limit applies only to the residual section entities. For example, if you are running a medical institute and if you are doing some commercial activities, this 20% receipt cap is not applicable to medical institutes. Similarly to educational institutes, similarly to institutes who are into yoga or preservation of environment or preservation of monuments. So this 20% limit, in short, is applicable only to those organizations which are falling in the residual section. So this is about 215. Now coming to section 1023C. In 1023C, we have got two types of educational institutes, One is the educational institute and one is the hospitals or medical institutes, which we call it. Now, when we talk about educational institutes, there are again 3 types of educational institutes. One educational institute is the institute whereby the government has funded a substantial amount. Substantial amount means more than 50% of the amount. Those organizations are tax-free. Then we have another type of organization. In that organization, suppose if the turnover of the organization in all is 5 crores, not more than 5 crores, this organization will be exempt from income tax. Then there is one more category whereby it is not falling in the earlier 2 categories. When we talk about the 3rd category, that means it is not substantially funded by the government and the turnover is more than 5 crores. In that case, you will have to apply to the income tax department. As Mr. Sahay explained, you have to apply to the income tax department and then obtain the approval from the income tax department. So these are the three types of categories in education. Similarly, these three categories are there in medical institutes also. So basically, we are dealing with these 6 types of categories. Certain case laws are mentioned. Of course, earlier, the limit for the second type of category, where we are talking about the turnover limit of 5 crores, earlier the limit was 1 crore. Now, by the Finance Act 2022, there is one more change as far as these organizations are concerned. Earlier, we used to talk about purely medical institutes. We used to talk about purely educational institutes when we are talking about a turnover of rupees 1 crore. But now, the Finance Act 2022 has said that if you are running an institute which provides medical services or which runs a medical institute as well as an educational institute, in that case, the combined turnover of both types of institutes will be covered for exemption. In other words, a total turnover of 5 crores from both the activities will be considered for exemption if the turnover crosses 5 crores of both the entities or both the types of activities. In that case, you will have to apply for registration and obtain the approval from the income tax department. So that is about the turnover. I have mentioned over here from Finance Act 2022-23, 5 crore limit to be applied in aggregate and not as per institution. This is also mentioned. If the receipts are flowing from education as well as medical activities, a total of rupees 5 crores will be considered for exemption. There are certain judicial pronouncements. There is no specific guidelines as to what you mean by annual receipts. We have to go through the judicial pronouncements. I've cited 2 judicial pronouncements, which will show some light that how we can calculate the annual receipts. As when Mr. Sahay was speaking, we were discussing about the flurry of amendments which have been made by the Finance Act 2020, 21 and 22 as well. So I have jotted down all the amendments. What all are the amendments? I will cover one by one, all those amendments one by one. Now, first of all, I will talk very briefly about the registration process or the approval process. When we talk about 1023C, it is an approval process. This has to be approved by the income tax department. Now, earlier, the approval was given for perpetuity. Now that approval has been reduced to a period of 5 years. And organizations which are registering themselves afresh, there is a new system whereby if you have not started your activities, if your organization is afresh, in that case, you get provisional registration for a period of 3 years. So that, when you register for a period of 3 years, you can start with the activities of fundraising, etc. And once you have the required fund, you can then you can go to the income tax department to regularize your approval for a period of 5 years. So the entire process is explained. As far as 1023C is concerned, it is explained in the provisos. One more very major change which has been brought by the Finance Act 2020 is regarding the audit reports. Audit reports of the NGOs and charitable section 1023C entities. What is that change? The audit applicable to charitable organizations is now brought at par with the business organizations. In other words, you have to obtain the audit report 1 month prior to the due date of filing the income tax returns. That is, as per section 139(1) read with 44AB, the due date for filing return is 31st October and the due date for obtaining the audit reports is 30th September. So this is a very major change as far as audit reports are concerned. Earlier, there was no such requirement. The only requirement was before filing the income tax return, you have to file the audit report. It may be filed on the same date. You may file the audit report first and then you can file the return. But now the things have changed. You have to first obtain the audit report 1 month prior to the date of filing the return. You may file the return on the date you have obtained the audit report also. So that is also there. Now, this is a chart which has been provided in this PPT. I have shared the PPT with WRC. Anybody interested can take advantage of it. This chart gives you a bird's eye view of the time limit for application, time limit for passing the order, period of approval, exemption available for which year, the forms to be applied, and the orders you will get in which form. Like just now, Mr. Sahay in his address was talking about 10AC. You can see in the very first instance, whereby the application is made in form number 10A and the approval is received in form number 10AC. So there were a lot of ambiguities as far as the order under section 10AC was received. So all those ambiguities have been put to rest by the circular which has been issued, and now the conditions have been changed. The provisional, we were getting the registration for 5 years was also mentioned as provisional registration. So that everything has been taken care of. And now after that, when we are applying, we are receiving the orders properly in the form in which it has to be received. So that is taken care of as far as 10AC is concerned. Then coming to 10AB, 10AB also Mr. Sahay referred to the circular. Now that circular says whatever applications were to be made by the 29th of October 2022, the date has extended to 30th September. Now, what does this mean? For example, if you have received your provisional registration in the month of say May 21, you have started the activities in the month of say June 21. Now, as per the provisions of the law, you have to apply for registration or approval within 6 months from the commencement of the activities. Now, that period of 6 months falls somewhere in the month of November, sorry. Now, suppose if you have not applied in the month of November. So now, in that case, you can apply up to 30th of September. So that is what that circular has given a relief to that extent. Now, one very short footnote which I would like to bring to the notice of all the participants. The application for approval under section 1023C of the Act in form number 10B, for which the last date for filing falls on or before 29 September 2022, may be filed on or before 30th September 2022. The circular number is also given and the date of the circular is also given. Some other changes which have been brought now by the Finance Act 2021. If property held under trust includes any temple, mosque, gurudwara, church or other place notified under section 80G to be, any sum received as voluntary contribution for purpose of repairs or renovation may at the discretion of the trust be treated as forming part of the corpus, subject to conditions. Earlier, it was not so. This is a very specific amendment. One example which I can understand why this amendment has been brought is the construction of Ram Janambhoomi Mandir. That is why I believe, and there may be many other instances, but the very obvious reason which I can see is because of this very huge construction which is being coming up. This amendment has been brought whereby the recipient, whereby the SSE or whereby the trust is given the discretion to treat a particular donation as corpus donation subject to conditions. What are those conditions? Otherwise, the trust is not given the discretion to treat any donation as a corpus donation. And very rightly so, because corpus donation is tax-free. Now, what are the conditions? Coming to the conditions, corpus to be applied for the purpose for which it is received. Number one. Number two, no donation to be made to any other person from that amount. Number three, corpus should be separately identified. You have to earmark that fund separately in your books of accounts. Fourth is, the money should be invested as per section 11.5. Section 11.5 specifies the modes where you can invest the accumulated amount. So strictly you have to follow section 11.5 of the Income Tax Act. Now, one more explanation has been introduced. If any of the four conditions specified in 1A above are violated, the amount becomes taxable in the year of violation. Introduction of explanation 3. Now, the amendments from 1/4/2023. By these amendments, as we heard Mr. Sahay saying that the organizations approved under section 1023C are brought at par with organizations approved under Section 12A, whereby the exemptions of Section 11 are applicable. Earlier, the provisions similar to 11.2, 11.3, 11.3A, which we are going to cover later on, these provisions were not there as far as 1023C organizations are concerned. So 1023C organization, while these amendments have been brought at par with organizations which are registered under Section 12. So these are the other amendments. Then 10th proviso to be substituted with effect from 1/4/2023. Keep and maintain books of accounts and other documents in such form and manner and at such place as may be prescribed. Of course, the prescription has not yet come, but it will definitely come. So as we discussed earlier when Mr. Sahay was addressing us, that and the chairman also was raising this issue, that there are a lot of irregularities as far as charitable trusts, books of accounts, etc. are concerned. So this is an effort to bring everything, try to bring everything in place, try to systematize everything. So that is why this amendment has been brought in. 15th proviso is also substituted, talks about power of PCIT or CIT. Now what is this? The PCIT or the CIT can suo moto take cognizance of any trust which is violating the provisions of income tax or which is violating the provisions of any other act related to it. The PCIT may suo moto take cognizance of it, or the assessing officer can bring to the notice of the PCIT saying, this is the irregularity which is happening in some of the trusts. Now, going forward, I am covering 143(3) here itself. What will happen? Once a reference from the ITO is made to the PCIT, then the end of the quarter in which the application is made to the PCIT, 6 months from there, 6 months from the end of the quarter in which the reference is made by the ITO to the PCIT is supposed to pass an order regarding the reference, either rejecting the 12A registration or accepting the 12A registration. And once the order is received from the PCIT to the ITO, only then the ITO can make the assessment order. And the time utilized or the time which is spent in this process, to that extent, the time given to the assessing officer for assessment will be extended. So this is the provision of 143(3), which is, of course, I will be referring to it further ahead also. Specified date for the passing of the order I have covered. Changes in the Finance Bill 2022 as passed by the Lok Sabha. Now, what has happened is, Finance Bill 2022 suggested some changes, and by the time the Finance Bill was produced before the President for his consent, there were also some changes which came to the notice of the Income Tax Department or the CBDT, and those changes were also made. And one of those changes was, earlier, no power was given to PCIT to reject or to cancel the provisionally approved trusts or provisionally registered trusts. So that was a small loophole, of course, but by the Finance Bill 2022 as passed by the Lok Sabha, the provisionally approved word has been added. So now the PCIT or CIT will have the power to withdraw the registrations or approval of regular registered trust organization also, as well as provisionally approved trust or organization also. So that is what it means. What is specified violation? Income applied for objects other than objects for which the trust institution was formed. Income from activities not incidental to attainment of the objects. All these have been mentioned. Routine, nothing special in this. Explanation 3. If no action is taken on the reference from the AO under first proviso of 143(3) till 31st March 2022, such reference shall be deemed to be received by the PCIT or CIT under the second proviso of 143(3) on 1/4/2022. That means the PCIT has to pass the order before 30th of September 2022 in that case. 19th proviso, what does it say? Prescribed authority and reference to notification replaced by PCIT or CIT. Now, again, there is one more explanation introduced by the Lok Sabha, by the bill presented to the Lok Sabha or passed by the Lok Sabha. Institution cannot take simultaneous benefit of exemption under Section 1023C and Section 1046. Suppose if you are notified under Section 1046, 1023C registration will automatically become inoperative. Now, provisos inserted after proviso 19. As per Section 12A(1)(ba), to avail the benefits of 11 and 12, the return has to be filed as per Section 139(4)(a) within the prescribed time under Section 139(1). There was no such provision for trust institution falling under Section 1023C, 4, 5, 6, and 6A. By this proviso, the trust institution falling under so and so sections have to submit their returns in accordance with the proviso of Section 139(4)(c) read with Section 139(1). So earlier, this was not specified. Now it has been specified. Income applied for direct or indirect benefit of specified persons as defined under Section 13(3) to be taxed. This was also not mentioned for 1023C entities. Now that has also been mentioned. Then one more change by the Lok Sabha. The finance bill inadvertently mentioned that such benefit should become income of the specified person. Of course, when there is a violation, when they are spending the money for specified person, that will be added to the income of the charitable trust and the tax will be levied on the charitable trust. So inadvertently it was mentioned as the income will be taxable in the hands of the specified person, which has been corrected. One more change, surplus to be taxed after allowing expenditure. Now, this change is a very welcome change because we have seen, you must have also seen in your practical experiences that you have received many of the 143 ones, that is intimation from the income tax department or the rectification for that matter, whereby if the trust is not registered under Section 12A, the entire gross income is put to tax at maximum marginal rate. So to deal with that particular situation, this particular amendment has been made whereby the expenditures will be allowed against your gross receipts subject to conditions mentioned herein. The TDS provisions made applicable to 1023C entities also. If the TDS is not deducted, 30% of the expense will be disallowed. If expenditure made in cash of amount equal to 10,000 or more than 10,000, it will be disallowed. So this has been made applicable to 1023C entities also. Now, one more very major change is some payable shall be considered as application of income during the previous year in which it is actually paid, irrespective of the previous year in which the liability was incurred according to the method of accounting followed. Earlier, what used to happen? Even if you are booking an expenditure, it was allowed as an application towards the objects of the trust. Now the situation has changed. Now the amendment says, the explanation says that you can treat the amount as application towards the objects of the trust only when it is spent. Suppose in the financial year 2021-22, you have booked an expense but not paid the amount. So it will not be allowed as an application towards the objects of the trust. It will be allowed as application towards the objects of the trust only when it is paid. For example, if you are paying it in the financial year 22-23, that is the time when it will be treated as an application towards the objects of the trust. Coming to section 11.1, 1023C is more or less over. Coming to section 11.1. Now what is 11.1? 11.1, everybody knows that out of the 100 rupees which we receive towards as a gross receipt, you have to apply 85% towards the objects of the trust and 15% will be a sort of a standard deduction. That can be accumulated for perpetuity. Then one more change which has been brought by Budget 2021 is application from loans and borrowings shall not be considered as application for charitable or religious purpose. However, when loans and borrowings are repaid from the income of the previous year, such repayment shall be allowed as application in the previous year in which it is repaid. That means what used to happen is earlier, suppose if you are short of funds and you have to spend towards the objects of the trust, in that case, you may borrow the money from the trustees or some other person. In that case, the income and expenditure will run into deficit. So that will not be allowed now. The amount will be treated as application towards the objects of the trust only when the amount received as loan will be repaid back. When it is repaid, it will be treated as an application. Now, one circular number I would like to bring to the notice of the participants is, it provides that any loan or support provided to the beneficiary should be treated as application and should be treated as income if any repayment is received. Vice versa is also true. Like we are talking about the application, similarly, if you are giving a certain amount of loan, that can be treated as application towards the objects of the trust, and when you receive the repayment, it can be treated as an income. Income applied on activities outside India. You can spend money on activities outside India only when those activities are approved by the CBDT by a general or a special order. Otherwise, if you are spending the money in violation of Section 11(1)(c), in that case, the amount spent outside India will be put to tax. And with the recent amendments, it will be put to tax at maximum marginal rate. So, but in any case, I would recommend that whenever you are coming up with a constitutional document of your charitable organization, you should definitely mention that you can spend money on activities outside India, but make a mention also that you will spend the money on activities outside India, only activities which are approved by the Central Board of Direct Taxes or the central government. So at the time of registration also, you will not have a challenge. Then coming to section 11(1)(d), 11(1)(d) talks about corpus. Income in the form of voluntary donation made with a specific direction that they shall form part of corpus of the trust institution will be exempt from tax. Now, some important points I have mentioned. I am not running through all those points because we have other things to cover also. So this PPT has been shared. Again, I am reiterating that you can go through the PPT. It is very detailed PPT and it will help you with your queries. Important pointer is tax will be charged on the income spent in contravention of Section 11(1)(c) when we are talking about amount spent towards activities outside India. Again, Budget 2021 has come up with one more amendment. Suppose if you are utilizing the money lying in your corpus fund towards the objects of the trust, it will be treated as application towards the objects of the trust only when that amount is compensated back to the corpus fund. So this is one more amendment which has been brought, similar to loans and advances. One important case law that which may help the participants, the Supreme Court has held that even interest generated on corpus donation is excluded from income if the donor provides specific directions in this regard. Everybody knows that for corpus donation to be treated as corpus fund, there has to be a specific direction from the donor. There is no specific format for the donor to write, saying that by this money should form part of the corpus fund. You can make a simple note. There is no specific format, and that money can be treated as corpus fund only after your direction. Other conditions to comply with so that you can avail the deduction under Section 11(1) is the trust should be registered under Section 12B of the Income Tax Act, 12AB of the Income Tax Act, and books of accounts are audited as per Section 12A(1)(b) of the Income Tax Act. Now coming to the explanation. Explanation 11(1)(a) and (b). Now what is this explanation? I'll explain with an example. Suppose in the financial year 21-22, you have booked certain income. Somebody has committed that I will pay you say 10 lakhs as donation or income, whatever, as the case may be. But you have not received that amount. If you have not received that amount, how will you apply towards the objects of the trust? So this explanation comes to your rescue. In that case, this explanation provides that you can take a deduction of that amount for the year in which you have booked the income, and then you can file a form number 9A with the Income Tax Department saying that I have not received this amount, but I will use this amount either in the previous year in which I received this amount or the next previous year. So that amount will be allowed as an application towards the objects of the trust. There is one more example. Now suppose if you have received the amount, but you have received the amount, say, on the 31st of March. In that case, it will be difficult for you to apply towards the objects of the trust. In that case also, you can file form number 9A with the income tax department, and you can tell them that we will utilize this amount in the next financial year towards the objects of the trust. So in the year in which you have received, it will be allowed as an application towards the objects of the trust, whereas the amount has to be actually spent in the next financial year. Suppose if you are not spending that amount in the next financial year, it will become taxable in the next financial year, in which the default has occurred. So this is about explanation and the violation of the explanation. Now, when Mr. Sahay was addressing, he was referring to the circulars. Circular regarding form number 9A and form number 10. Online filing of the forms was made mandatory from the assessment year 16-17. People were not used to it. They made a lot of mistakes. They forgot to file the form. They filed the form after some time, after filing the return. So that is why these circulars have come to the rescue for the assessment year 16-17, 17-18, and 18-19. Why these circulars? The PCIT or the CIT has been given the powers to condone the delay in filing these forms. And Mr. Sahay also told us the amount of liability which they have reduced because of these circulars. Genuine liabilities which were to be reduced, but because of this technical glitch, they were facing challenges. So the delay got condoned in filing form number 9 and form number 10, and similarly, the corresponding liability also was reduced. Then coming to corpus donations from one trust to another trust. Now, from the financial year 17-18, that is assessment year 18-19, one explanation has been added, whereby if you are making a corpus donation from one charitable organization to another charitable organization, it will not be treated as an application towards the objects of the trust for the trust who is donating that amount. Only inter-charity donations can be treated as applied towards the objects of the trust only when general donations are made out of the income which has been earned by the organization or which has been received by the organization, or the income derived in the financial year. Suppose in the financial year 21-22, you have derived an income of say 1 crore rupees. In that case, if you are making a donation of 50 lakhs towards the corpus of the other charitable organization, in that case 50 lakhs will not be treated as application towards the objects of the trust. And further, the CBDT and the finance department clarified that this particular amendment is applicable to 1023C organizations also. So any donations made from 12A registered organizations to 1023C also will be treated in the same fashion. In short, if you are making a corpus donation from one charitable organization to another charitable organization, it will not be treated as application towards the objects of the trust for the organization who's donating the amount. Of course, this amendment has got no impact if the corpus donation is given out of accumulated funds. Now again, this is regarding the TDS part. We have already covered when we were discussing 1023C. Same provisions have been introduced over here. Earlier, as far as section 11 is concerned, these provisions were already there from the assessment year 1920. In 1023C, they have been introduced now. No set off or deduction or allowance of the previous year allowed towards the next income of the next financial year. Now, what does this mean? Earlier, there were cases whereby in a particular financial year, there was deficit. And that deficit was carried over to the next previous year and adjusted against the income of the surplus of the next financial year. So now by budget 2021, this has been put to rest. The deficit of one previous year cannot be adjusted against the surplus of the subsequent previous year. So this is what the amendment means. Now again, similar to 8IG 2B, we have already covered in 1023C. amount received towards temple, mosque, gurudwara, church renovation, subject to certain conditions, can be treated as corpus donations. We already discussed this. And the result of violation of the consequences of violation of these particular conditions we have already discussed. Some important points, some important case laws. You may go through it for your reference. One very important thing, a lot of people ask me that even if 100% of income is donated to another valid trust, the entire donation shall be treated as application for charitable purposes. Yes, this has been decided in many case laws, and irrespective of the fact whether the recipient of the donation spends the money towards the objects of the trust or not, you have made a valid donation. Now, there was one more case law which said that Section 12A registration cannot be denied if permission to take loans is not taken from the Charity Commissioner's office. As per the Charity Commissioners Act, in Maharashtra, talking about specifically Maharashtra, it is the Maharashtra Public Trust Act 1950. But with the present scenario and introduction of 12AB, 5B, any violation under any other act, the Income Tax Department may take cognizance of the same and cancel your 12A registration if there is a violation under any other act. So, of course, this particular amendment is superseding the case law which we are discussing. Section 11(1)(a) talks about your capital gains. My take on capital gains is very simple. Suppose if you have a capital asset and if you are selling the capital asset, I would recommend that you show that entire proceeds as your income. That I have sold this asset, you book it as your income, and the amount can be applied towards the objects of the trust. 85% of that amount can be applied. And when you purchase a capital asset, as everybody knows that the entire capital expenditure cost can be debited to the income and expenditure account. So I would definitely say that let us not go into these formulas. A very practical approach is whenever you purchase an asset, you debit to your income and expenditure account, and wherever you sell an asset, you credit to your income and expenditure account. So that will suffice. And otherwise also, if you are complying with Section 11(5), if you are purchasing some FDs, if you are depositing the amount in your bank account, you have complied properly. So you will not land up paying any capital gain tax. In my practical experience, I have never seen that any of my trusts has paid capital gain tax. Of course, the very important case laws have been mentioned. You may go through it. 11(1)(b), consequence of non-application of income after exercising options under clause 2 of the explanation 1. We discussed earlier, about the consequences of non-compliance also. Just to refresh once again, if you have received the amount and if you have not spent the amount in the next previous year, the amount will become taxable in the next previous year. If you have not received the amount will be taxable in the previous year, subsequent to the previous year in which the amount has been received. So that is about Section 11(1)(b). 11(2), again, most of the people are aware that you have to file form number 10 for this, whereby the amount can be accumulated for a period of 5 years so that some major expenditures can be made. Why this is beneficial to the charitable organizations is, suppose if you have a budget of say 100 crores, you are planning to spend some 100 crores on your particular activity, or you want to come up with a school building, or if you want to come up with a hospital building. In that case, you may accumulate the amount over a period of 5 years. And you may spend within 5 years. Now the provisions, how does this 5-year work? 5-year period shall commence from the year succeeding the previous year in which it is accumulated. Suppose if you have accumulated the amount in the financial year 21-22, you may use the amount before 31st March 2027. Of course, the money so accumulated again has to be invested in the mode specified as per Section 11(5) of the Act. The return has to be filed on time. Of course, Section 13(9), let me discuss about Section 13(9) right away. What does 13(9) say? that when you are accumulating the amount under section 11.2, in that case, you have to file the returns on time. On time means, suppose in the present scenario, the due date to file the return is 31st October and the due date to receive the audit report is 1 month before the due date for filing the return. In that case, if you are exceeding the time limit or if you are violating the time limits, in that case, you will not be allowed the accumulation under section 11.2. Whereas in filing form number 9A, you can file the form number 9A till the end of the assessment year. So this is a very basic difference as far as 9A and 10 is concerned. In 9A, you can file form number 9A up to the end of the assessment year, And in the case of form number 10, you have to file the returns, you have to file the audit report in time prescribed by 139(1) of the Act. So this is the basic difference as far as form number 9 and 10 is concerned. Form number 10, when you file, is required to be uploaded. The following documents and details should be prepared for accumulation. Resolution has to be passed by the governing body for accumulation under section 11.2. Accounts to be submitted to the AO within 6 months from the end of each relevant previous year, which is the due date for filing the returns, of course. Though plurality of purpose is not precluded, the purpose has to be specific, precise, and concrete. What is the purpose? Purpose for accumulating the amount under section 11.2. Certain case laws. While the circulars which I have referred to 1617, 1718 and 1819, specific powers has been given to PCIT, have been given to the PCIT to condone the delays in filing form number 10. In most of the cases, people have not filed form number 10. They have filed it after filing the return. So those cases are being condoned. In many of my cases, I have seen that, as Mr. Sahay said, that condonation process is not at all difficult, provided your case has got merits. 11.3. Exemption of section 11.2 withdrawn if specific conditions not satisfied. So what are those conditions? The amount is applied to purposes other than purpose for which the amount is accumulated. Ceases to remain invested in as per section 11.5. Is not utilized for purpose for which it is so accumulated or set apart during the year period or in the year immediately following the expiry thereof. Now, this particular 11.3 earlier was giving a grace of 1 year, but that amendment has been brought in. Now you have to spend the money before the end of the 5th financial year subsequent to the year in which the amount is accumulated. The amount so accumulated cannot be donated to another organization. So these are the conditions. If you violate these conditions, your exemption under section 11.2 will be withdrawn. Earlier, a period of 5 years, by virtue of section 11.3, that the period was coming to 6 years. But now that ambiguity has been removed. Now you have to, if the amount is not spent at the end of the 5 years, then in that case, it will become taxable in the 5th year, not in the 6th year as the provision was there earlier. You can modify your purpose. Generally, I have not seen so, but of course, the provisions are there. Section 11.3a says that conditions for availing the relaxation. Request can be made to the income tax department or the assessing officer, saying that these are the reasons why I am not in a position to use the amount for the objects for which the amount has been accumulated. So please grant me leave and allow me to use the amount for some other objects as per my trust deed. So after verifying the merits of the case, the assessing officer may allow you to modify the objects of the trust or modify the objects for which the amount has been accumulated. Section 11.4 and 4a talks about business entities. Now, when we talk about section 11.1, 11.1 includes the 11.1 says that income arising from property held under trust. Now, property held under trust means business undertaking also. So that is what section 11.4 and 4a says, and how the business has to be conducted and governed as per the provisions of section 11.4 and 4a is mentioned out here. various case laws have been cited over here. One very important point, there is nothing in the statute to suggest that tax audit under section 44AB shall apply to business undertaking under section 11(4)A, as long as registration under section 12AB is intact. Section 11(5), these are the areas where you can invest the amount of the trust, accumulated amount of the trust. Now, if there is a violation of section 11(5), only the income arising from such violation will be put to tax at the maximum marginal rate. That is one very important point which needs to be brought to your notice. Otherwise, everything is like, this is an exhaustive list. Of course, things are being added every now and then. For example, stock certificate as defined by Sovereign Gold Bond Scheme 2015 has been added lately. Coming to section 11(6), 11(6) says that depreciation will not be allowed if the entire cost of the asset is debited to your income and expenditure account. And very rightly so. Section 11(7), earlier, Mr. Sahay also made a mention of this. Earlier, there was no clarity. If you are registered, if you are approved under section 1023C, if you are not approved under section 1023C, if you are approved under section 12A, you may claim the exemption under section 1023C also. A 1023C organization can claim deduction under section 11 and 12 also. So earlier this was the case, but now this ambiguity has been put to rest. Now, if you are approved under section 1023C and you are approved under section 12A also, in that case, your 12A registration will become inoperative and you will be allowed to use section 1023C deductions. So this is what is 11(7) talking about. There is one more amendment. This is also being discussed earlier, that when the amount is actually paid, it can be treated as application towards the objects of the trust. Section 12, now section 12 talks about voluntary contribution. Section 11 talks about income generated from assets held by the trust. So when you are making your income and expenditure account, your income account will show income generated from the assets held under trust and voluntary contributions received under section 12 also. 12A, everybody is aware, for getting yourself approved under section or for getting registration under section 12A. Nowadays, 12AA is replaced by 12AB. You have to make an application in form 12AB. A very important takeaway in this is that when you are if the trust is already registered under section 12A, the window was open from 1/4/2021 to 31st March 2022, whereby it was a very simple process. You had to just apply and you would get the registration for the next 5 years. But as we were discussing at the beginning of the session, when you are going for a re-registration after the expiry of 5 years, that is the time when the department will investigate your case. It will see the genuinity of your case. Of course, timelines, I'm not discussing about what are the timelines. A chart is being mentioned in the end of 12A section. Again, audit report, we have already discussed. We have to file the returns by 31st October and you have to obtain the audit report 1 month, at least 1 month before the date of filing the return. That we have already covered. (12A2) talks about 12A2 talks about your effectivity of your 12A registration. Suppose if you are registered under subclause 1, and suppose if your organization is registered in the year say 2015, you will be registered, you will be considered as a registered organization under section 12A from 2015. If you are provisionally registered, the first year when you were provisionally registered, your registration will be considered from that financial year. Some case laws, and one more very important thing, constitutional thing, when you are into formation, when you form a trust, the 6 clauses which are required are mentioned over here. I would strongly recommend that whenever you do the formation of the trust, please check in for this 6 clauses, because when the income tax department will investigate your cases, they will look for these 6 cases now, 6 clauses now rather. So 12AB defines the process of registration under section 12A. The timelines are given. Broadly, the timelines are when the trust was already registered. Of course, now it is no more effective now. When you had to apply from 1/4/2021 to 31st March 2022, the registration was to be given within 3 months from the end of the month in which the application is made. It is no more relevant now because the time has already passed. And when you will go for the registration for the next time, whether it is provisionally registered or whether it is regularly registered, in that case, you have to apply 6 months before the expiry of the registration. And then when you register first time, when we call it a provisional registration, the registration will be granted by the department within 1 month from the end of the month in which the application is made. So these are the timelines, and PCIT has been given powers to cancel your registration under the circumstances mentioned, and we have already discussed those circumstances. Case laws, again, a lot of case laws. This will throw a lot of insight to the participants. Again, the chart, the timelines defined. The only 2 things which have been added in this chart is, one is if there is a change in the objects of the trust. If there is a change in the objects of the trust and you are not complying with the conditions under which you have been granted the registration, within 30 days, you have to apply to the income tax department for a fresh 12A registration. Then one more possibility is, we have already discussed this also, registration of trust has become inoperative due to the approval under section 1023C or 1046. If your 12A registration has become inoperative, and if you want the 12A registration, so you have to apply at least 6 months before the commencement of the assessment year, from which the said registration is sought to be made operative. So that is the time. Now suppose if you want your 12A registration for the assessment year 2022-23, in that case, you have to apply maximum by 30th of September 2022. So this is what the timelines mean. Again, powers of principal CIT to take cognizance, to assess the risks and consider a case on the referral of the assessing officer also, whether to cancel, whether to approve the registration under section 12A. So again, as we had discussed in 1023C, that these are the same provisions. The specified date has been mentioned. Specified date again is within 6 months from the end of the quarter in which the first notice was issued. More or less, everything is repeated. This is a chart, bird's eye view, how section 11 operates and how section 12 operates. Now we come to section 13(1), denial, withdrawal of exemption. Section 13 has been enacted as an exception to section 11, and thereby the benefits which are otherwise available under section 11 and 12 will not be available under the circumstances stated in section 13. What are those circumstances? Income applied for private religious purpose, income of charitable trust institution applied for benefit of particular religion, then income applied for the benefit of specified persons. Now, when we are spending the amount for specified persons, there are a lot of amendments as regards specified persons. We will cover one by one whenever, as and when they are coming. Then funds invested or deposited otherwise than in any other or more forms specified in section 11(5). So these are the 4 circumstances where you will be denied the deduction under section 11 and 12. 13(2), what does 13(2) say? The income or the property of the trust or institution or any part of such income or property shall be deemed to have been used or applied for benefit of the person referred to in subsection 3 of section 13. If these are the circumstances where it will be treated that you have applied the amount of the trust or you have spent the money of the trust for the benefit of the specified person. These are the circumstances as mentioned in 13(2). And 13(3) is the definition of the specified person. Who will be called a specified person? I'm not going into the definition part. Of course, I'm not left with much time, but I will cover the subject, don't worry. 13(4). Exemption shall not be denied if the investment of the trust or institution in a concern in which the specified person has a substantial interest, provided such investment is not more than 5% of the capital of that concern. You have a concern whereby there is a certain amount of capital and the specified person is one of the stakeholders in that organization. But if the trust invests an amount which is less than 5% of the capital of the concern, in that case, it will not be treated as a violation. This is what it means. What does 13.6 say? 13.6 say that if you're spending an amount when you're running an educational institute or a medical institute and you are extending some services to the specified person, in that case, either the concession given or the services given for free, the differential amount or the entire amount of services, as the case may be, will be treated as violation. Only that amount will be treated as a violation. Otherwise, the entire exemption will not be disallowed. 13.7 talks about anonymous donation. Anonymous donation is what? 30% flat rate of tax will be levied on anonymous donations. And the limits are 5% of the total donation received by the SSE or 1 lakh, whichever is higher. That will be exempt. That will be exempt. Otherwise, any amount exceeding these limits will be taxed at maximum marginal rate. There are many case laws whereby we are saying that at times there are concerns regarding religious organizations whereby you have got dan petties and you receive anonymous donation in those dan petties. There are various case laws whereby it has been decided that amounts received in donation boxes will not be treated as anonymous donations and will not be put to tax at maximum marginal rate, because the intent of the law is not to tax petty donations received from donors in religious organizations. The intent of the law is to check money laundering, is to check conversion of unaccounted income. So that is the intent of the law, and genuine intents will definitely be considered and will not be treated as anonymous donations for taxation purpose. Many case laws which I am referring to are cited out here. Of course, section 1, very important note which I would like to throw some light over here. Section 115 BBC does not apply to institutions falling under section 1023C 2AB and 1023C 3AC. What are these organizations? Organizations having more than 50% of the government stake. For these organizations, 115 BBC is not applicable. 13.8. What is 13.8? Going back to section 215 and the proviso to section 215, 13.8 says that if you are crossing the limit of 20% of commercial transactions in a particular year, the 12A, the deduction under section 11 and 12 will be disallowed only for that particular year. In other words, if you are complying with the 20% threshold limit in the subsequent year, suppose in the subsequent year, your turnover from the commercial business or the commercial activity is 19% of the gross receipts. In that case, you will again be granted the deduction under section 11 and 12. In other words, one more thing is, if 12A registration will not be cancelled if charitable purpose ka definition is denied to you. So that is what 13.8 means. 13.9 we have already covered. Filing of form number 10, you have to do the filing on the due date, on or before the due date. If you are doing the filings of form number 10 or anything related to section 11.12, accumulation under section 11.12, if you are doing beyond the due dates prescribed by 139.1, in that case, your accumulation will be disallowed and it will be put to tax. Again, we had discussed earlier, expenditure will be allowed against the gross receipts. Same thing as we had discussed in 1023C. Subsection 11 has been added for the purposes of computing income chargeable to tax under subsection 10 above. No deduction in respect of any expenditure or allowance or set off of any loss shall be allowed to the SSE under any other provisions of the Act. Yes. 115 BBI, new section. It is proposed to tax the specified income at the rate of 30% in the hands of the trust institution without allowing any deduction of expenditure. What is specified income? Income accumulated or set apart in excess of 15%. Accumulated amount is not invested in the specified mode of investment. Income accumulated and not applied for charitable purposes. Income applied for benefit of specified person, and income applied for charitable purpose outside India, of course, in violation of section 11(1)(c). So this is a specified income. If there is any specified income, it will be put to tax at maximum marginal rate. Finance Bill 2022 Lok Sabha clarified that 115 BBI will have an overriding effect over anything contrary. For example, section 164(2) also. The Finance Bill Lok Sabha has inserted proviso to existing proviso of section 56(2)(10) to provide that clauses 6 and 7 of the existing proviso deemed income shall not arise under section 56(2)(10) if money or property is received from 1023C institution or trust registered under section 12A. Now, let us come to the explanation part. Now, suppose if a charitable organization is giving certain donations or giving certain amounts to some other person, in that case, by virtue of section 56(2)(10), it was not to be treated as a deemed income. But now this amendment has been brought in. What is the amendment? That if the organization registered under section 1023C and section 12AB, if they are giving any amount to specified person, in that case, it will be treated as a deemed income of the person, of the specified person who is receiving this amount from the charitable organization. Proposed new section 271. Now it is a new section, of course. There is no proposed as such. 271 AAE by the Finance Bill 2022, where the income of the trust institution is applied for direct or indirect benefit of the specified person, as defined in section 13(3), a penalty equal to 100% of the amount so applied shall be levied on the first violation. On subsequent violation, a penalty equal to 200% of the amount so applied shall be levied. So it is a huge penalty. So the trusts have to be very careful in applying amounts for the benefit of specified persons. ATG, of course, nothing much to talk in ATG. Certain very important, the chart is also covered over here. The timelines have been defined. The only thing is you cannot make a cash donation of over 2,000 rupees to a ATG approved trust. Of course, the trust can accept the donation, but you will get deduction only up to the extent of rupees 2,000. Section 234G, late fee of rupees 200 per day in filing form number 10BD, and another penalty is prescribed, minimum 10,000 up to rupees 1 lakh on violation of ATG 58 or ATG 59. So these are the two penalties which have been prescribed. Of course, I believe that for the financial year 21-22, the government will have to take a lenient stand because there are a lot of things which are yet to be clarified. Of course, the department has clarified a lot, but still there are a lot of things to be clarified. I'm not going into 115 TDTF. 143.3 I have already covered. Coming to section 164(2) and 3, read with section 167B. Now, what are these sections? Let me take a practical example. Suppose if your organization is not registered under section 12B. In that case, the department, what the department is doing? The department is sending you intimations under section 143(1). And the department is taxing the gross receipts at maximum marginal rate. Why? Because they understand that if you are not registered under section 12A, the deduction under section 11 and 12 are not allowed to you. And the trust becomes an AOP. And under section 167B, the AOP has to be taxed at maximum marginal rate. So this, I believe, is not a correct view as far as 164(2) and 3 and section 167B is concerned. According to me, 167B has given a specific exemption to organizations registered, charitable organizations registered under Society Registration Act 1860 and similar acts. And 164(2) and 3. What 164(2) and 3 says? 164(2) and 3 says that only if there is a violation under section 11(5) or if there is a violation under section 13, only in those cases tax can be levied at maximum marginal rate. Whereas when we talk about our example, there is neither violation under section 11(5), there is neither violation under section 13, and 167B has specifically exempted charitable organizations from being levied tax at maximum marginal rate. So my humble view is I have dealt with many cases whereby a lot of liabilities were standing in the name of the trust, huge liabilities were standing in the name of the trust, but this matter was dealt with the income tax department and proper justification from our end was given and it was rightly accepted by the income tax department. So I would recommend that we have to always seek the help of 164(2) and 3 vis-a-vis section 167B to contest the liabilities whereby the organizations are not registered under section 12 of the Income Tax Act. So this is about 164(2) and 3, and this is about one more very important case law which I would like to bring to your notice. Many a times there is a case law rather, Messrs. KMR Educational Society. What it says that even if the organization is not registered under section 12A, the surplus has to be calculated on commercial principles. What are commercial principles? Income minus expenditure. This is accepted commercial principle. And the surplus has to be put to tax. And that too at the rates applicable to individuals. Maximum marginal rate should not be levied because a trust has to be treated as an individual. It is a group of individuals and it has to be assessed as an individual on the basis of individual taxation, whereby 2,50,000 is exempt from tax, then the first slab is 5%, then 20%, then 30%. So this is about the case law, and I don't think I have missed on something. Definition of income besides being a single human being. So this is about 164(2)(3) and section 167B, which brings to the end of my syllabus for today. Of course, because I had limited time, I had to hurry on certain points, but I think I have done justice for whatever I have been allotted today. So I would recommend CA Piyush Chandakji to take over the question answer session now, because we are left with 10 minutes, I believe.
Yes, sir. So, sir, there are 3 questions appearing in the question answer box. The first one is from Mr. Haresh Badai.
Yeah.
Can we apply for condonation delay for not being able to apply for 12A and 80G for financial year 21-22 due to technical glitches?
No, sir, I'm afraid now because you cannot apply for condonation now. The only remedy which we have is after 31st March 2022, we can go for a provisional registration. You will get a provisional registration because 31st March 2022 is the final date and that cannot be condoned as far as I understand.
Okay, sir. Thank you. Should we take up a next question, sir?
Yes.
Next question is from Bhavna Vatare from Nasik. What would be the treatment of unutilized investment, that is FDR, for particular purpose made from corpus fund by the unregistered trust, now registered from AY 22-23? That means in the time of 5 years to be considered, and from the actual acceptance of the funds or from the registration under the Act?
No, I mean, can you read the question once again?
Sir, what will be the treatment of unutilized investment, FDR, for the particular purpose made from corpus fund by the unregistered trust? The trust was unregistered when the FDR was made. Now registered from AY 22-23.
Registered from AY 22-23. Okay.
And from when the time limit of 5 years to be considered? From the actual acceptance or from the registration date?
See, first of all, first and foremost, 11.2 comes into play only when you are registered under Section 12A. Otherwise, 11.2 does not come into play. So once you are registered under Section 12A, and if you accumulate that amount in that particular year, from there you have to calculate the next 5 years. Now, when you are talking about an amount which is accumulated when the trust was unregistered, and it is a corpus, now that corpus can be carried over for perpetuity. But once you register, because you have not filed form number 10 for that particular accumulation because you were not registered, you can file form number 10 once you are registered under Section 12A. And once you accumulate that amount in the financial year 2023, 5 years has to be calculated from there. That is, till 28 you can utilize the amount. For the amount which is accumulated at the time of unregistered, that corpus donation can be carried over for perpetuity because it is not conveyed to the department that this amount is accumulated for 5 years.
Okay, sir. Okay. So we will take up the next question.
Yeah.
It is, can a donor get ATG deduction on the basis of provisional registration of the trust?
ATG donation, if the trust is provisionally approved under Section ATG, suppose if you have obtained a provisional approval under Section ATG, which is available nowadays, and if a donor is making donation to a trust which is approved under ATG provisionally, he will get a deduction. Because that is the sole purpose of introducing provisional registration or provisional approval.
Okay, sir.
The donor will get the deduction.
Okay. The next question from Pranav Maniarji.
Hmm.
A Section 12A registered trust has started medical services such as laboratory, ophthalmology, dental section, diabetic center, etc. In-house hospitalization is not provided. No in-house hospitalization services from 1st February 2021. Is the registration under Section 1023C required?
No, Section 1023C registration is not required because, as you said, the trust is already registered under Section 12A. And when the trust is registered under Section 12A, we should refer to Section 215, which defines the charitable purpose. And under the charitable purpose, medical relief is considered as one of the charitable purposes. So you are into medical relief. So you need not take a registration under Section 1023C. Registration under Section 12A is good enough.
Okay. So his next question is whether the pharmacy will be tantamount to commercial activity.
No, pharmacy, there are many case laws which have been decided that pharmacy is an integral part of the medical organization. Of course, it has to be seen on a case-to-case basis. But if you are providing free services, if you are providing medicine at a concessional rate, of course, that will be seen. Because in 1023C, there has been a recent judgment which says that the trust is charging money based on the market rates and the exemption was disallowed. So we have to be very careful when you are running a pharmacy. Are you giving the medicine at concessional rates or subsidized rates? Because if you are charging at the market rates, it can become a challenge.
So his next question is 15% should be applied on the contributions received, or it also includes the revenue generated from the activities?
15% is the amount under Section 11(1) of the total income of the trust for that particular financial year. Suppose if the total income of the charitable organization is say 1 crore rupees for a particular financial year, in that case, 15% amount will be 15 lakhs. That will be a standard deduction which can be accumulated for future use.
Okay. So his next question is, what is the recourse if 85% of the contribution received is not applied in the relevant previous year?
That I think we have already covered. Suppose if you have not applied 85%, you can either accumulate that amount by filing form number 9A. You may use that amount in the next financial year, or you may want to accumulate that money for 5 years under Section 11(2).
Okay.
These provisions are applicable only to accumulations over and above 15%.
Okay. His next question is, corpus fund under saving account, whether it is considered as an investment under Section 11(5).
Yes, sure.
Okay. And last is, can non-religious trust receives anonymous donations up to 5% of the total donations or contribution received?
True, yes, they can receive, because if they are receiving, if they are maintaining the limits prescribed under Section 115 BBC, it is not a problem. Once you, how the anonymous donation ka thing is calculated. Let me take a practical example. If you have received a total amount of say 1 crore as your donation, and 1 crore ka 5% will be 5 lakhs and 1 lakh. So 5 lakh is higher. So suppose if you are, and the anonymous donation is say 4,50,000. In that case, you are less than 5%. So it will not be put to tax. In other words, suppose if you are receiving 6 lakhs as anonymous donation, in that case, 5 lakh will be exempt and 1 lakh will be put to tax.
The next question from Anil Agarwal ji.
Yeah.
Only FD interest is there to the trust and no other receipt. Whether the same is taxable and at what rate?
See, if you have a FD and if you are gaining interest on the same, the interest will be shown in your income and expenditure account if there is no direction from the donor. That income will be shown as your income, and if you are spending the money out of that, if you are not complying with the 85% criteria, provided I am assuming that it is registered under Section 12A, in that case, you will get a 15% deduction, and the remaining 85, if you have not applied the entire amount of interest towards the objects of the trust, that 85 rupees will become taxable, and the rates applicable to the individuals will be applied. So one deduction will be 15%, then the other deduction will be 2,50,000, and on the balance, the tax will be levied.
Next question from Tejas Kumar Shah. There is a trust which has filed Form 10 BD, but still in donors 26 says it is not showing. So is there any practical solution for that?
No, I think we are also expecting, generally we have received the resultant form 10BD. In response to 10BD, I think we received 10BE, if I'm not wrong. And then still in our cases also, there are various occasions whereby it is not reflecting in 26 years. In due course, it will happen. That is not a problem. And I think there should be some relaxation given by the department, because there are a lot of things which are to be set right till now. But it will definitely appear. But as a matter of fact, there is no practical solution as such as at the moment. We have to wait.
What about applicability of Section 194R and the calculation of turnover for the same?
194R. I'm not very much aware of this 194R, because this is nothing related to, charitable trust. 194R is your business turnover, sir. And as far as charitable trust is concerned, no provisions as relating to business are applicable over here.
Okay, sir. There are many questions. We'll take up one by one again.
Not a problem. Not a problem.
What about the donation received in financial 21-22? I think.
What about the donation received in financial year 21-22?
This is the only thing written in the question. I don't know the context about the question, sir.
Next question.
Next question from Sriranga Kolkar. Expenditure was not made less than 85%. Expenditure till date of filing to be considered as expenditure for 85%. Till the date of filing to be considered?
No. Financial year.
Financial year. Okay. Next question from Rashida Kapasi. Date of incorporation of a trust has been mentioned in PAN card wrongly. NSDL refuses to accept this change application form and unable to file return as portal shows mismatch. ITO refuses to cooperate. Any practical solution?
Now, these are cases whereby before registration of the organization, you have applied for PAN. Nowadays, it is not happening so. Earlier, it used to happen that before registration, before you receiving the certificate from the Charity Commissioner's office, you could apply for PAN. And you used to get the PAN based on the date which is mentioned in the constitutional document. And now when you receive the certificate, it has got a different date. So what I would recommend in this case is you have to apply afresh. You have to surrender your earlier PAN and you have to apply a new PAN with the proper dates as mentioned in the certificates issued by the regulatory body. That is the only practical solution.
Understood. Sir, next question is probably for us. Is there any ICI course available for trust? So
I don't think so.
I don't think so. There is any
Well,
certificate.
now, recently we discussed about a book which is published. So, I mean, we can refer that.
So WIRC is organizing various seminars, sir. You have to attend those.
Yes, yes, yes.
Next question from Dheeraj Agarwal ji. Under 11.2, it is compulsory to have FDR for 5 years, or we can renew it every year till application.
Yes, you can renew. You can renew. The only condition is that you should comply with section 11.5. You can renew every year, because practically also, suppose if you have accumulated, say, a period of amount of, say, substantial amount, and the purpose for which the amount is accumulated, if you have to meet that purpose, and if you have to spend that amount in the subsequent year, you can definitely spend that amount also. So that for spending that amount, you will need the money. You have to rotate your FDs. So it is allowed.
Thank you. Next question from Shefali Jain ma'am. The inclusions to total, that is gross receipt, for the purpose of 20% threshold limit for commercial transactions will include indirect incomes like bank account interest too?
Of course, it will include, because let me clarify. I have mentioned in my slide also that from the income tax department, there is no clarity on the subject. We have to take a very practical approach. According to me, the business receipts plus the non-business receipts, both of them have to be calculated, and then 20% has to be 20% has to be calculated on both the amounts.
Okay. So the question from Shubham Petkar, he has, I think, rewritten the question. The question was applicability of section 194Q to the trust and calculation of turnover for the same.
No. Not applicable to charitable trust, I believe.
Okay. Next question from Srirang Akolkar ji. One trust has receipt of 7 crores. It has expended 4 crores and accumulated 2.95 crores. Whether 5 lakhs will be taxed at slab rate?
Yeah, no. So let me be very clear on this. Your gross receipt is 7 crores.
Yes.
I'm assuming that it is registered under section 12A, and you are spending that 6.95 crores. 2.95 is accumulated. You are left with 5 crores. But if you calculate the 15% of 7 crores, which is available under section 11.1, there will be no taxable income. There will be no taxable income. So there is no question of applying the slab rate. And even if there is an applicability of tax, in that case, the slab rate will be applicable.
Okay. Next question is, if we have filed form 10 for AY22, can subsequently file another form that is 10 or 9A for subsequent AY?
Of course, we can do.
Okay. Next question is, old trust is registered with Charity Commissioner, but not registered under income tax. Also, no income tax returns are filed till date, but all Charity Commissioner filings are done on time. And now the trust apply for provisional registration for 3 years and then go for permanent registration.
Yes, they can. First of all, you have to go for provisional registration. Of course, they will ask for the accounts. So I would recommend that the accounts which have been filed with the Charity Commissioner can be produced before the income tax department, saying that in all practical circumstances, the income was below taxable limit. That is why we have not filed the returns in income tax department, but the accounts are audited and we are submitting those accounts. So first it has to be registered and provisionally registered. And then after beginning with the activities and meeting the time limits, we have to apply for regular registration as and when the due dates are met.
Okay. The next question from Jignesh Ganatra ji. Charitable trust have received property as gift. How to record the same in books of account? Also capital gains if it sells that property. And if it invests proceeds from the sale in 11.5, is trust eligible for exemption or it has to apply the sale amount?
See, one thing is very clear, that when you receive a property as a gift, it is not an income, it is not something which is liquid. So there is no question of applying that amount towards the objects of the trust. It will straight away, you will say that if the property is valued, say 1 crore, you will say that 1 crore is your corpus donation and 1 crore is your asset. This is number one. Then when you sell the property, the proceeds will be your income for that particular assessment year. The proceeds will be income, and that income, if you are investing in section 11.5, whatever that income, against that income, what you are spending has to be seen. and anything which is left over will be put to tax.
The next question from Kasim Soniji.
Hmm.
Whether nil form 10BD is also compulsory to file?
No, not required.
Okay. Next question from Nilesh Khatuji. Trust established in the year 1980 is registered under the Income Tax Act for the first time in March 2022 under the new scheme. It was carrying out charitable activities continuously since 1980.
Right.
Granted provisional registration under the new scheme for 3 years. Whether such trust requires to file Form 10AB on or before September 30, 22 to get fresh or continuation of registration.
Yes, of course, because when you see the time limits mentioned are within 6 months from the date of the activity. As you said that the trust is already into activities. So we can always say that when you have received your provisional registration, at that time also the trust was doing activities. So right from day one, the activities are there. So you have to apply for a regular registration within 6 months from the date of the activity. So you have to meet that time limit, not the time limit of 6 months before the expiry of provisional registration. You have to meet the first time limit. So definitely it will fall before 30th of September.
Next question from Geronimoji. Whether audit required for 1023C III-AB cases?
III-AB cases. AB, not required. Not required.
Next
Audit is required only for the last category. 10AB category is the category whereby the government has substantial grant in the particular organization. In that case, form number 10BB is not required to be filed.
Next question from Mayur Shikeji. Whether tax audit under section 44AB applicable to trust?
No.
Next question from Vasudevan Ayarji. 15% under section 11(1) can be utilized for any other purpose, or equivalent investment under section 11(5) is to be created.
Section you have to invest in section 11 as per section 11(5), because that is your accumulated amount. The accumulated amount will go to your capital or your reserves and surplus, and that has to be invested as per section 11(5). And of course, section 11(5) also says that you can purchase immovable property. You can purchase immovable property out of that, or you can invest in FDs. You can keep in bank account.
Sir, can you just more define about inclusions in the education as defined in section 215, as the education is a broad term?
Yes. I mean, of course, as he is very rightly saying that it is a very broad term, but promotion of education, I would definitely say that anything which is done on a very highly commercial basis will not be called as an education. Because when we are talking about exemption, the type of education or the areas covered under education is less important as compared to the activities which are being conducted under the educational scenario. So that has to be seen, and it has to be seen on a specific basis, on a case-to-case basis.
Next question is time limit for investment under section 11(2).
Time limit for investment under section 11(2). Once you accumulate the amount, suppose if you are accumulating in financial year 21-22, in that case, the 22-23 financial year, there is no such time limit mentioned, but I believe either the amount will be in the bank account or it will be invested in FDs. Even if the amount is lying in the bank account, we have complied with section 11(2).
Okay. Sir, are there any compliances for NRI trustees who stay out of India over 12 months?
See, NRI trustee, first of all, when we talk about Maharashtra, in Maharashtra, the trusts are governed by the Maharashtra Public Trust Act. The Maharashtra Public Trust Act says that if the trustee is not in India for more than 6 months, in that case, he cannot be a trustee. He should resign from the post of trusteeship. So that is the compliance. And now when he is talking about 12 months and above, in that case, he cannot be a trustee of the trust. So it is better you submit a change report, you take his resignation, and if you want to replace him as a trustee, you should replace him with another trustee.
Okay.
That is the compliance you should do.
Okay. Next question from Hiren Sangvi. Accumulation of 15% on gross income or after deduction of establishment expenditure and expenditure on properties.
After expenditure.
After expenditure.
After all the expenditures.
Okay. Next question from Harshit Patel. Tax audit applicability on trust registered under 12A and gross receipt is more than threshold specified under 44AB.
Tax audit is not applicable.
Not applicable. This same question is repeated again.
Yeah.
Next question from Anonymous. If the trust is in the work of providing menstrual education and healthcare to poor by giving them kits, that is pad, soap and calendar, kits are given for free to poor but are funded by different Rotary Trust on per kit distributed basis on which invoice is generated by NGO to Rotaries. This is major way of receipt for this NGO. Will this count as the specified income and need to be restructured under 20%?
No, first of all, I would not say it is a commercial activity, because whatever amount they are receiving in the form of donation received. They are not making any profits. Nobody is taking home any profits. So according to me, it is a charitable organization. There is no question of any commercial activities being done by the charitable organization in this case.
This NGO is a Section 8 company after. Okay. So I think question is answered. Next is from Ajinkya Redkar sir. I have a doubt. Sorry. Suppose a trust receives land as donation. Then such land is to be treated as corpus of the donation. If yes, then to claim exemption, should an amount equivalent to the value of land to be deposited under Section 11(5) modes?
No, not required. There is no provision in the Act which says that if you are receiving any donation in kind, has to be converted into money and invested into Section 11(5). As per Section 11(5), there is no such provision. Okay.
So many questions are repeated. I am just deleting those questions.
Yeah.
Okay. If a trust or Section 8 company forgoes its 12AA, what will be the impact on its Section 8 status?
Section 8 status, there will be no impact on Section 8, because if he is foregoing Section 12AA, in that case, of course, the accredited income section 115 TD, TF will kick in. Suppose if the organization is running for quite some time and they have accumulated certain amounts and they are foregoing the 12A or the 12A is being cancelled, in that case, the trust will be, the gross receipts at fair market value have to be calculated, minus the gross assets minus the liabilities will have to be calculated at fair market value, and the surplus will be put to tax at maximum marginal rate.
Okay. If failed to apply for registration for existing trust, what should be the practical solution?
No practical solution. I believe this is talking about 1/4/2021 to 31st March 2022. That time limit has gone. The only solution now is he should forget about the older registration, 12A registration. He should go for a provisional registration now.
Okay. One question is, does the CA have to certify Form 10BE, or it is just a self-generated like TDS certificate?
Self-generated.
Okay. Next question is on tax audit. It is done. Next question. If the trust is in the work of providing, sorry, the question is done. Next question, Jai Narayanji Gupta. Gita Press is earning every year about ₹5 crores from textile and Ayurvedic medicines, spending the same in subsidizing the books and accommodation, etc. Whether the textile and medicine receipts liable to tax?
No, it is a charitable organization. Now, first of all, the trust which they are talking about, the objects of the trust has to be seen. What are the objects of the trust? If the income generated is spent towards the objects of the trust, as defined by the constitutional document, in that case, it will be treated as a charitable purpose, and only the surplus will be put to tax at the rates applicable to individuals.
Okay. Sir, the question about surrender of PAN and new application of PAN was there. It was the 1953 registered trust. So is it okay to surrender the PAN now?
Yeah, I mean, there is no other way out.
Okay.
I mean, there is no other way out. Absolutely, there is no way out. In such cases, what we practically do is the trust is into operations for the last so many years. Now, whatever we have to apply for the PAN afresh, the returns have to be filed on the new PAN number. And we have to file the necessary resolutions and transfer the entire thing to the new PAN number.
Okay, sir. I think most of the questions are now answered, and the questions are being repeated now. So, very much thank you very much, sir. And I will call upon CA Rinki Gorwara to propose a formal vote of thanks.
Rinki Gorwara is traveling.
Yes, sir. Sorry. Sir, it's an immense pleasure. On the behalf of WRC, I extend a hearty vote of thanks. The subject that you chose was a really vast subject, and there are too many new tax implications which are coming up. And you tried to solve each and every query. That was the best part of it, So we are really thankful you spend your busiest time with us. So it's a great honor to hear you. Thank you very much.
Thank you so much. Piyushji, one request I would like to make here. Now, there may be many questions. There were many questions. Suppose I have answered those questions, but even if the members need, more clarity, maybe I have assumed certain things, or maybe I have not got the complete information. So if the members are seeking further clarity, they can always write to me. They can always call me up, and I will answer their questions. Not a problem.
Yes, sir. Thank you so much, sir, because I was about to say that we have answered around 50 questions till now, and there are many questions, some of getting repeated. So we have to close the session because considering the paucity of time.
But one thing is very sure. I mean, on this platform, I would like to tell that if there is any other query, they can write to me. I will answer. I think I can answer all the queries. That is not a problem.
So that we know you can answer all the queries with proper patience and.
Yeah.
Okay. So thank you very much for your extending your cooperation, sir. Thank you very much on behalf of WRC. And now I announce the seminar is formally over. Thank you attendees for joining and to be present till the question answer session was there. Sir, around 200 people were present.
Thank you. Thank you so much.
Thanks
to WRC and all the office bearers. Thank you so much.